Hello. Good morning, everyone. Or we're almost getting into afternoon here. So, welcome to this session on inclusive finance. I just want to start by noting that the financial inclusion space is at a very, very interesting inflection point at this time. I'm sure many of you who are in this room are familiar with the government push for financial inclusion, the Jan Dhan Yojana, and the trilogy of Jan Dhan, Aadhaar and mobile that the government has been positioning and promoting. We've also had RBI take a very, very progressive stance on advancing financial inclusion and issuance of about 21 bank licenses last year, provisional licenses for new sort of banking entities. We've had the microfinance sector, which forms a bulk of the financial inclusion sector, having undergone through a major crisis in 2010 and sort of coming back with a bang around that. Very recently, we had an IPO of the second leading microfinance institution in the space. So all of this to say that there's a lot happening here and a very interesting point in the history of financial inclusion in India. And today it's very pertinent that we are having this discussion. And I think we are very lucky to have this panel that we've put together because these are people all with multiple decades of experience in financial inclusion, both in India and outside. And so we will benefit from their learnings and their experiences. But also each of them come from a slightly different stakeholder within the space, and therefore what I'm hoping is we'll hear somewhat different, perhaps even contradictory perspectives on what's needed for driving financial inclusion in India. So the way we've designed this session is we are trying to make it as interactive as possible. I'll request all the panelists to start with a 5-minute introduction, just telling about themselves personally and their organizations. We'll then have a presentation, a single presentation, just to sort of set the context of what's happening with financial inclusion in India and what are some of the key challenges. I'll then share a few questions with the panelists, and then we'll open it up for question and answers. So in terms of introduction, I'll just start with myself and then request the other panelists to introduce themselves. My name is Chandni Ohri. I am the CEO of Grameen Foundation India. Grameen Foundation is a global not-for-profit headquartered in Washington, D.C. We've been working in the space of financial services for about 2 decades now. And our role is primarily working with a range of financial service providers, ranging from microfinance institutions to banks to mobile money providers to farmer cooperatives and other entities, and figuring out or helping them figure out what sort of business models, what sort of technology solutions, what sort of products and processes they should have in place to reach out and deliver financial services effectively to the poor and the unbanked. So that's primarily what we do. In India, we are really trying to drive the adoption and usage of digital financial services because we believe that that's a channel that can really help bring a lot of the poor into the fold of formal financial services, and a lot of our effort is also going towards how do we ensure that a wide range of financial products are available to that segment. And lastly, but certainly not the least, how that segment of the poor and the unbanked can really be equipped to make intelligent decisions about what sort of financial products they should be using towards what purposes. So I'll just stop here and pass on the mic to Ragini for her introduction.
Good afternoon, everybody. My name is Ragini Chourdhary. I work for DFID. It is a British government department, and it has been a development partner for India for a very long time. I'm part of their private sector team as an advisor, and I lead on one of their large financial inclusion program, which is being implemented by SIDBI. So this program is for improving access to financial services in the 4 poorest states. So we are focused on that. We are focused on financial services, and through this program, our key pillars are to improve outreach to the poorest, or whoever, when I use this word poor and poorest with a lot of caution, because we're talking about financial services and not other basic services. So improving penetration of microfinance services to low income households which are excluded. Reaching out to areas where financial services hasn't reached yet. It's about making ensuring that the financial services are delivered responsibly. Fourthly, it is about using technology and other innovative solutions to improve efficiency of delivery and bring down the cost, because that is one of the key concerns. And fifth and the most important part is about bringing in the gender lens in delivery of financial services. So it's not just about the women clients, but also the institutions and how they deliver services. Because the understanding is that you work with 95% women, microfinance is 95% women clients, hence your gender box is ticked. So we're moving institutions, not only MFIs, but others to move beyond it. So that's our project, which we are implementing through SIDBI, which comes with decades of experience of working in this area. So at present, we work with around 30 partners in these 4 states. That's it.
So hi, I'm Vipr Bhardwaj. I am part of the FINO Paytech Limited, which is India's largest business correspondent. We were founded in 2006 and rather incubated out of ICICI Bank, and we have been part of the business correspondent side of the financial inclusion drive which is happening in India for the past 10 years. Recently, we have been granted an in-principle approval for a payments bank, and presently we are changing tracks to become a payment bank also. And FINO Paytech has been working in rather business correspondent services for savings products and in Rashtriya Swasthya Bima Yojana largely, and we also do microcredit for some of the banks. So that is a brief profile, and now changing tracks to become a payment bank, hopefully by end of this year.
Good afternoon, everyone. I'm Puneet Chopra from Microfinance. Microfinance is a development consultant. We are about a 17-year-old organization, and we work in about 50 countries, primarily focused on microfinancial services. In India, we have been doing work in the space of financial inclusion for about 10 years now. We work with the practitioners, we work extensively with the regulators to support in policy advocacy and transformation of policies, and we also do research to bring in inputs from the field. So our focus is around the customers. A lot of the work that we do is primarily centered around customers, product development, channel improvements, which we do with supporting the various practitioners, banks, and other providers. And as Vipr kind of mentioned, 21 new licensees in payment banks, small finance banks that are coming up. We are also engaging with them and trying to support them as well.
Good afternoon, everyone. I'm Pallavi. I'm from Microfinance Institutions Network, MFIN, and I'm the head SRO and compliance officer over there. MFIN is quite a young organization established in 2009, but it is a SRO recognized by the Reserve Bank of India, first SRO to be recognized in the country for the RBI regulated NBFC MFIs. So MFIN works at 2 levels to tell you. One, it is the SRO, and also it represents the industry association, industry voice of the sector, the private regulated NBFC MFIs in the country. So our primary role engages around, I would say, of course, on the SRO front, on the self-regulation. We have a wide range of activities which RBI requires us to do. We do a lot of surveillance activities on our members in terms of whenever RBI asks us to do some kind of deep dive studies, we do that. And we also keep on doing semi-inspection activities on our members also. And then we have dispute resolution activities, because in a typical SRO you have disputes between members. So we resolve disputes between members and take actions on that. We are also required to do grievance redressal for the microfinance clients. So we have a lot of, like a typical ombudsman, some complaints come from microfinance clients to us, so we resolve that and take actions on that. And then we also provide data and analytics services for the industry, and then also development activities like financial literacy or developing modules for the microfinance staff. But as an industry association, because we represent typically the know-how of the industry, we closely work with our members so in terms of plugging policy gaps, like even working on small finance bank guidelines. We were very closely involved in that. So typically now we have 51 NBFC MFIs as MFIN members, or spread across the length and breadth of the country, almost 50,000 crore portfolio that we have, and almost 3 crore clients, and it's spread across all states, I would say.
What is SRO you were saying?
Yeah, SRO is a self-regulatory organization. So typically a new concept in India, I would say, but it's like a typically quasi-regulator that RBI requires you to, regulate the institutions over there.
Great, thanks panelists. So as I think maybe evident to all of you, like I was saying, we have very diverse perspectives on this panel. So we have Ragini representing a donor and a funder. We have Vipr representing a practitioner, a financial service provider, Puneet representing a technical expert in this space, and of course Pallavi representing a network of organizations. So that's the diversity in our panel today. I would now request Puneet to make a presentation on the state of financial inclusion and particularly highlight some of the areas that are where we performed well and where challenges remain.
Thanks, sir. So, as Chandni said, in terms of financial inclusion, we are really at an important cusp and inflection point. We've been watching this space and doing a lot of market research in the last 7-8 years. Post the launch of Pradhan Mantri Jan Dhan Yojana and a number of associated schemes after that, we are really seeing a sea change in how things are on ground. So we have done national-wide research, 3 rounds of it in the last year and a half, and I'll present some of the results from that. So we started this countrywide research in December 14, then we repeated it in a bit of last year, and then towards December. And we looked at a number of areas. So Bank Mitras is essentially the frontline channel for delivery of financial services, whether it is banks or commercial banks, RRBs. A lot of them are using Bank Mitras as the sort of frontline channel, because for most banks, outreach of branches is limited. So it's always a combination of branches, rural branches, and BCs earlier, and now BCs and Bank Mitras that are being leveraged for delivery of financial services. So from a PMJDY perspective, the service delivery, the opening of accounts of PMJDY, and then service delivery along with all the other associated schemes under insurance and pension. So Pradhan Mantri Jeevan Jyoti Bima Yojana, Suraksha Bima Yojana, which are insurance schemes, and Atal Pension Yojana, which is pensions, and then a number of other schemes that have been launched. They are being delivered through the BCs and the BMs. Prior to the launch of PMJDY, there were no national level sort of products and services. So essentially, it was banks' own products and services. And what we found was that the uptake was really limited. There are very few products which are really targeted at the bottom of the pyramid. So other than opening an account, a basic sort of savings account, re-questioned multiple times. So, BSBDA, basic savings account, which is the latest sort of terminology. Beyond that, there were a very, very limited number of products and services. So, under the umbrella of PMJDY, all these new products and services have been launched. So, we try to look at how they have been performing over the last year and a half. So, it's not coming well. If you look at how at the Bank Mitra level, their own readiness. So in the past, their own availability. So if you see today, a Bank Mitra is required to be in each sub-service area SSA, but when we started, it was as low as 89%, which has grown to now 97%. That's simply in terms of availability. In terms of transaction readiness, so whether the Bank Mitras, BCs are equipped with micro ATMs or other transaction devices, depending upon whether they are using and again depending upon who the service provider is, whether they are using a PC or a laptop to really transact, are they fully enabled in terms of connectivity, in terms of devices to transact, and then are they properly branded, and is there enough sort of awareness and visibility? How would a customer know that this is the person who is representing SBI or ICICI or another sort of bank, and one can go and transact there. So on all these fronts, if you see, there's been a tremendous improvement over the last year and a half. If you look at the devices itself, the basic biometric devices which did not have Aadhaar enablement and which were not RuPay card ready, that is now at 89%. The Aadhaar enabled devices, they have improved from about 69% to 72%. So 72% of the devices that we sort of surveyed are now Aadhaar enabled. And you would know that under PMJDY, RuPay cards have been distributed with each account. So that continues to be still a challenge area. It has improved to about 50% now. But this is still only the card, the PIN. So as we all know, unless we also have a PIN, so distribution of PINs in rural areas is a big challenge. And then for the PINs to come in for the villagers who have their first experience with banking, for them to understand, this is a card and this is a PIN and I need to keep it safe. First of all, how to activate that? I mean, it's a long journey beyond just receiving the PIN itself. So we are at 50% where the cards have come in, the PINs will come in, and the PINs expire in 3 months' time. And what we are finding on the ground that by the time the PINs are separately coming in, either through the BCs or because they are not going in as, unlike the way we receive mail, there is no address at the villages. It's a village itself is the address. And then it has to be distributed either at the panchayat level or typically by the BM itself, because essentially it is a banking service. So they would come in batches at the nearest bank branch or to a BC, and then after that it is up to them to distribute. So many of them are kind of lying there, and then the entire learning journey for them to start knowing about PIN, start using it. I mean that's sort of still a long journey. eKYC, which is really a great innovation, as you'll see in some subsequent slides as well, in terms of account opening and other services. I mean, today Aadhaar enabled electronic KYC, and we have done a separate study in which we projected the sort of savings that could accrue to banks and to telecom operators and others if they could start using electronic KYC. And we estimated that over 10,000 crores could be saved for banks alone if they start using eKYC across their various sort of frontline channels. In terms of transactions, we are seeing a very, very significant increase in the transactions at the BM points. And as you would know, that essentially the business model for the BCs, Bank Mitras, is the transactions that they can do. It's a mix of a fixed compensation every month, or sometimes it is totally variable. But certainly there is an element of fixed and variable. So the more transactions they do, of course they have been getting some money for account opening, but now that over 213 million accounts have been opened, that is coming down significantly. The source of income from accounts opening itself is now going to be limited. So they are rewarded on the transactions they do. So unless they are getting enough customers, they are able to do enough transactions, they will not be able to make money. So that we see a very significant surge, almost 44% increase there. And that leads to compensation. So as you can see, over the 3 rounds, we are now seeing a compensation at an average level of about 4,700 rupees. This is sort of an average. The spectrum is very, very wide. Still at the lower end, you would find people who are not getting even equivalent to the minimum wages. So, you know, it is an irony that many of these BMs actually are giving out money or servicing customers who are, let's say, making minimum wages under Narega or other sort of services, but they themselves are not getting even as much as the minimum wages required. But that's changing. Suddenly, if you see almost a 19% increase just in the last 6 months from July to December. Financial education for BMs continues to be a challenge, but there is certainly improvement there. So in the last round, we found that only 27% of them have received any sort of formal education about what they are supposed to do, and they are actually managing quite significant technology. You know, they are not trained bankers. They are actually playing the role of a banker at a small branch for that matter, and they are single-handedly managing that. So training is extremely important for them, and they are using technology. You know, they are not using paper to transact. So, but that's an area which needs a lot of more attention. In terms of other challenges, in many cases, sort of, for example, passbooks are being issued, and this is very important from a trust standpoint. Again, there are costs associated and so on, but at least the banks who have made it a choice that they will be issuing passbooks. The printing of passbooks and updation of that when they transact is something that is not happening at PM point, which is as a result the trust of the customers as well as the convenience. Both those issues. And as related to the fact that they are not trained adequately, the additional schemes, for example, the complexity of servicing an insurance scheme, and even under the PM JDY umbrella, I mean, leave alone the individual insurance schemes which bank insurance, etc. can offer. It's fairly complex. So for them to be able to service that in terms of who is the nominee, how the nominee process works, how the claim process works, there is a lot of knowledge that is underlying knowledge that's required, which is sort of not available. So they are at a loss to service many of those products. And then in terms of basic connectivity, there's still and that's a sort of longer term issue. Technology, the mobile networks are gradually moving in there, and that's a problem we face sitting in Delhi, that our data services and our voice call itself fail so much. So we can imagine there. And they are totally dependent on this. The only connection, unlike a lease line which comes into a branch, the only mechanism for them to transact, and it's all online. The offline model had a lot of problems, which was stopped quite some time back. So they need at least a GPRS connectivity, and they are only able to do it through their mobile phone. So that's an area which is still needs some attention. From a customer standpoint, there is a lot of euphoria, and they're really liking the benefits and the features that they see. On the products itself, if you see the 12 rupee and the 330 rupee, that's how people understand it. They really don't relate to it as PMJJ, BY, or SPY. The adoption is still slow, but also because one is awareness of the customers themselves, but that is being addressed through a lot of marketing efforts by the government on national channels, other ATL, BTL activities that are being done, but also because the channel is constrained and banks themselves have, there is more work to be done from the bank's side itself for that to happen. Aadhaar is clearly having a lot of impact. Not only in terms of the eKYC, but in terms of the transactions. People are finding transactions are now much more quicker, seamless. They are now getting subsidy through the DBTL, LPG is one of them, but of course very soon various others on PDS, on kerosene, on fertilizers. They would Manrega is already there, will start happening. So overall, there are a couple of things which we believe should help. One is we still feel that the entire DBT and PMJDY at various levels is seen as different programs. There is convergence required on those because unless the basic PMJDY and associated challenges are not addressed, the DBT will sort of maybe fall flat. DBT, LPG has been the easier one and the low hanging fruit, but other schemes are much more complex. And then in terms of BCs, I mean the BCs, BMs are a channel of the bank, and they need to improve the norms of how they manage the BCs and BM. For example, in terms of minimum capitalization,
G2P,
government payments, government to people payments. For example, they need to be available and servicing on at least 5 days. The way the banks are open, the BMs and BCs also need to operate that way. They need to be audited just as every single branch of banks is audited with certain periodicity. The BCs and BMs also need to be audited. There need to be metrics in terms of their capitalization. I mean, today we find that there are large BCs of course, but there are also very, very small BCs who just come in and they have limited credentials. So if every kind of bank is required to have a minimum capitalization, how is it that it's not a requirement for the BCs and BMs? So, and that's why many of them are like fly by night or really do not have the ability to invest and so on. So that's an important area to sort of address. And then white label BCs, because like white label ATMs and ATMs themselves, where essentially irrespective of the bank one is banking with, anybody can go and transact. That's not the possibility. BMs represent one bank officially. Unofficially in metros and bigger cities, of course, they are transacting wherever it is remittance transactions. We find that they are doing, but it's really not allowed by regulation. So they are doing it illegally. So white label BC would important.
But we're using two technical terms.
Can you go back?
One is BC. BC we don't use this form, and BCNNs. I'm sorry.
Sorry. So BCs are the business correspondents, which are the agents or the frontline channel of banks. BCNMs are their network managers. So like Vipr was mentioning, FINO in that sense has been a BCNM for many years, and now of course they have got the in-principle license to become a payments bank. Thank you.
Thanks, Puneet. I totally sympathize with many of the people here who are not familiar with this sector or are starting to learn about the sector and finding it to be an alphabet soup, among other things. So maybe we can take a couple of minutes just to see if people have questions on the terminology, just that, so that the rest of the discussion will be useful for you. If there, apart from BCs and BCNMs, are there any other terminology issues that we're having? Any questions on that?
What is the DBT?
Direct benefit transfer.
Direct benefit transfer, that's also similar to G2P, government to people payment. So essentially the payments that government is making either for LPG subsidy or other subsidies or NREGA is another big Manrega is another big acronym, but those are all transfers from government to people.
Yeah, I guess that's okay.
Okay, so we can move on. I'd like to pose a question to each of the panelists and see what their responses are. Essentially, I think the feeling that we are trying to create here is that financial inclusion has been worked on for a long time. It's great that the current government has given it a huge impetus, and certainly RBI has also added its own, momentum to it. So my question is, are we seeing that with all the excitement and with all the developments that are taking place with the use of technology, are we really seeing that we will solve the financial inclusion challenge in the next 3 to 5 years? I mean, are we seeing that some really disruptive force is going to come and solve this problem for us, or like we've made over the last, I would say 3 or 4 decades, we will continue to make incremental progress, and we are still at least a decade away from really saying that, okay, we have achieved the goal of financial inclusion. So I'm going to start with Ragini and we just go down the path.
So, just to set a background, I was just reading in today while I was coming here. Government and people have been all fighting about how many poor people we have in India. And how do you define poverty? 25 rupees, 38 rupees, 42 rupees. And then you will have this TV cameras following up, and then there is a purchasing power parity. So by any account, by taking any poverty line that you're comfortable with, we can safely assume today that 50% of our people are poor. They are not included in the growth that we're talking about. We talk about over 7% growth. But India is one of the poorest, not poorest, it's a middle income country with highest economic inequality. One of the highest, it's on the lower end. So just keeping that elephant in the room, very much staring at us, then why we are doing this discussion today. So if we have to really increase the inclusiveness of these people, of our country, because we are also staring at a social problem, that how is it that the LWE problems exist and where it exists. Look at the location of it, and it will coincide with the location of poverty at most places. So there is a high correlation. So for our safety and our growth and enjoying this 7.3% of growth and our fat, comfortable middle class, where we all belong to, we need to understand that inclusion is very important. And PMJDY has laid the foundation. We have 19 crore accounts. Puneet will tell you how many of those are active. And it's a very, so it's a great foundation laid. And we have Aadhaar. And we are also talking about WhatsApp movement in banking, where things will happen. But we have a different view of the reality that exists there. And if we really have to make that journey, we have to be mindful of that reality. So, just to bring that point. So I think if we really want the inclusion to happen, we have to stop being fixated about numbers. Start looking beyond numbers. Quality is one thing. Don't hand over everything on public sector banks, which are already doing a lot. Any new scheme, Prime Minister announces very proudly, and my heart sinks for all the banks who have to achieve those numbers. You give them a target, they'll achieve it. Take it from me, they will. But Puneet knows, we're very good at achieving numbers. But then what happens beyond it? So I think government needs to start thinking about what support can we offer to the banks without really writing it off. See, if you look at them, the branch managers hardly visit their banking mitras. Many of the bank mitras don't even know what service they are supposed to sell, and they are the last mile delivery people. So that's where. So bank needs a support that can't come from inside, it has to come from outside. Who pays for it is something that we need to do. That is one. Another thing is, all these bank mitras, great, we are people, but who is de-risking this cash out that is happening from people who don't even earn minimum wages? That's a big issue. I just went to Uganda, where half of their population, which is much smaller than Delhi and Bombay combined, has mobile money accounts. They all use mobile for transferring money because banks didn't exist, so that was the best way to do remittance. But can you imagine 50% of them do it through agents who receives their one-time password on their behalf? So what is happening. It is still safer than transferring cash money, but look at it. So that's the thing that we are staring at. So of course this can all be digitalized, we can have WhatsApp, we have a UPI now. We are really ahead, the technology is all there. I think my request would be to get that human interface in between who bridges the gap between technology and the people who have a completely different reality from where we are. So I'll stop there.
Vipr, what's your perspective?
So we have been, FINO Paytech has been in business, rather FINO Paytech was incubated out of ICICI Bank because we were working on technology a platform which can provide easier access to banking for and solve the infrastructure issue. And we started around in 2006. And I would just like to dwell upon what happened in last 10 years. 2007 was when the business correspondent guidelines came in which, if you don't understand business correspondent is a regulation from RBI which says that bank can appoint an agency or an individual to serve a certain set of accounts which the bank can call it micro accounts on their behalf outside the bank premises. So that came into force in 2007. And what Ragini was pointed out, actually that happened. Government came out with mandates, RBI came out, DFS came out with mandates, and banks were asked to open accounts. And accounts were opened by banks appointed their own business correspondents. We were one of them. We opened accounts. Technology platform was not integrated at the bank's level, so banks, for a low cost kind of model, set up a separate instances of their core banking systems which were not linked to the main systems, and the accounts were opened on that. So actually what you define basic banking, let me assume for a moment that an act linking a bank customer or a rural customer to a bank account, active bank account, is a major step ahead in financial inclusion. So let me, so the accounts were opened. So what is a basic kind of saving account or a financial banking account? A customer should be able to open an account, digitize his cash, maybe digitally pay digital payment should be possible, or a reverse digitization should be possible. That means he can cash out. Till to around 2014, banks were having a separate instance. That means a customer opening a bank account, the bank account was opened at a central level. The local bank had no linkage to that bank account. He could have digitized his money, that means he could have saved his money, cashed in his money at a point on a technology platform which was not interoperable, so at his village only. He could have cashed out only at that point because it was not interoperable, the technology. The mandate was to open accounts. Mandate was not to make them active. So could he have done payments? No. No, the system is not linked anywhere, so he could not have done any payments. For record purpose, the account was opened and a person was handed over a savings account. So 2 or 3 things have majorly happened in last 2 years. One is Aadhaar, which has come in with AE KYC. That means opening of a bank account. If I want to open an account with Citibank today, I can open an account sitting in some district or zone. So that is possible. Citibank will accept that as eKYC platform. So that is possible. Can I digitize my cash? Yes. Once an account is opened with a platform, on a RuPay kind of a platform, which is now internationally accepted or nationally accepted, I can digitize at any point. Can I do a digital payment? Yes, I can do a digital payment through IMPS now. UPI has just come, so I can transfer, I can do payments. One of the key words presently is Paytm Karo, one of those things. So Paytm Karo is possible now for everyone with holding any account, because UPI has come in. UPI is Unified Payment Interface, which will link all banks. Can I do a cash out? The authentication part. I can do a cash out authentication because the bank Mitras or any platform is now connected on Aadhaar enabled payment service, which is a biometric or an OTP enabled service. So I can do a cash out. So the whole system has become interoperable. That is why you are seeing in Puneet's presentation, there is a surge in transactions in the last 6 or 8 months. Now, what is the missing key? What Puneet did not cover in this presentation was that for any transaction point to work, you need a device, you need connectivity to the platform, you need a board. Yes, you need a board. You need, one thing we are missing is we need cash. Ability for that person to hold some amount of cash, ability for that person to give away that cash when a customer requires it. That as an aspect is not getting addressed. That is why the customer pull to customer will invest, because he will say, I can save the money. Can I withdraw when I need? The bank mitra might have a limit of 5,000 rupees, and if he wants a 6,000 rupee cash withdrawal, or he has already exhausted that limit by 4,000 rupees, he is not able to give out that cash out transaction. The customer next time will not come to that point to do a transaction. And why a bank mitra will not invest from his own pocket? Why? Because there is no replacement of the form. If he has given a cash out of 6,000 rupees, to retrieve that 6,000 rupees back, he has to again travel to that nearest tehsil point to withdraw that. And maybe if it is not his own bank's ATM, he might be charged rupees 25. So these are some missing factors which are now, if the industry is able to address, I think the disruption is just around the corner. And one of the factors is that payment banks and SFBs are coming, whose only mandate is to serve this set of customers. And I expect innovations to come on the service side. Technology, the innovations have come on the service side to provide greater amount of service at transaction points at their branches for more customer acceptance. I think the disruption is around the corner.
Thanks, Vipr, for highlighting. Cash is absolutely a major problem, and the banking is the business of cash. So unless the entire channel is able to handle cash well, it's not going to work. And cash and liquidity, because there is also electronic. We are changing between cash and electronic money, digital, both at the point of agents. So, and that brings me to the broader point in terms of that. What has been challenging is that the traditional banks, the scheduled commercial banks, have not really seen this as an important business. It's always been driven by kind of compliance, and the whole drive to open the PMJDY account. If you see, the public sector banks have opened majority of those, almost like more than 95% or 97%, something like that. So still, it's not seen as a viable business. But a few banks who are seeing it as a viable business, and then they are offering the right products and services and doing it right. They are actually fairly successful in creating rural business as a fairly substantial business for themselves. And we hope that with the small finance and the payment banks coming in, whose focus will be more of these segments, there will be more innovation on products. Today, if you see tailored products or the right products which meet the needs of this segment, whether it is in terms of savings, insurance, pension and so on, is not there, other than the national products that have been launched under PMJDY. And microfinance institutions have been meeting the needs of credit, but then also that's sort of limited to largely the JLG models. But there is a whole missing middle in terms of, let's say, 50,000 to 5 lakh kind of credit, which nobody is really able to offer because of lack of collateral and so on. And there is hope that maybe the new small finance banks would attempt innovation in that space. And like to mention, at the back end, I think India is actually leading. We don't need to look at international examples. I mean, Bill Gates mentioned that the whole India stack and what's happening on technology in India actually could be a role model, transformational blueprint for others to look at. So, eKYC, Aadhaar, forming the foundation, the unified payments interface, the Bharat Bill payment service, and other elements of the India stack. That's actually going to be a blueprint for many other markets to look at. But it's the front end, that I think it is happening as we are seeing. There is a lot of progress in the last 12 to 18 months, but it is going to need more time. Hopefully in the next 2 to 3 years, we should be seeing that we should be probably much better.
My co-panelists have highlighted some very important problems, and Ragini especially saying we have really not reached, tackled the problem as it's 50% of the problem still remaining there. But why have we not been able to reach? I would like to focus it from the private sector side. We've seen the bank mitras, government doing very important role on the Jan Dhan Yojana and all. So if we see, the typically microfinance industry portfolio, I would like to bring to attention that typically focuses 400 odd districts in India. Just 50% of the portfolio is focused only on maybe 70 or 80 odd districts only. Why that's so? Why aren't they going to the other districts? They could well go there. So typically, what happens if we look at large number of areas like Uttarakhand or northeast areas, if there isn't income, where would the credit go? Only if they are credit worthy, only then the companies would go and provide them credit. And even on the deposit side also, only if people have income, only then they can deposit. Why do we have large number of unoperational accounts with the bank mitras? Because people put in money, because if they have something from the DBT scheme coming into their accounts, they'll put in there for some time, but then they would withdraw it as soon as it comes in. I think so the income aspect of it, I think that's where something that we have to focus on, and that would come from the government policy agenda. So I was just short while back part of the skill development, the session that was going on there. The skill development initiatives go a lot focusing on job creation, but is it also focusing on entrepreneurship? Business development. People who get skills should be able to develop their own businesses rather than always hunting for jobs. Only when they produce businesses, only then they would look for funding. So I think that's something as a policy agenda very important, that interlinkages between the financial institutions and these skill providers. Once that happens, they would be credit worthy, they would have deposits, and that would increase, the demand would also increase. So that's on the private side, while the government would do as a social benefit in terms of even if the bank operations, they are not profitable over there, they would still go over there. So that's why there has been a reluctance from the public sector banks also. They would rather focus on high net worth individuals or the middle class, but these typical customers floating the, thronging the typical branches, and then they would not be able to address their service concerns also. So that's on the one side, but yes, now that we have the small finance bank and the payments bank, that I would definitely feel they would bring definitely disruptive innovation in the country, because they are focusing on areas where the banks have not been there, have not been able to service, and the underpinning of them will be technological innovation actually. Only once they do that, only then they will be able to service these customers at lower cost, because banks, typically a banking operation has higher cost. So only if you use the technology, then only, and the licensees who have got, some of them, 3 or 4 of them, who are actually MFIN members, or they've been seeing how much they've been investing on technology. So only once that happens, they will be able to do that. I think that's very important. And looking at, I would also like to point out actually, the risks which are there in the industry in terms of concentration. That's where the otherwise, as a funders and all, they also need to look at. As these SFBs move out, we also need to promote the wider microfinance, some more players in the market also, some more NBFC MFIs coming in, and even maybe RBI is thinking of, on-tap licenses being there. So more such kind of institutions are needed in the market. So that's equity infusion, that is something very much required for the small MFIs in the industry.
Thanks everyone. I think we've heard a real diversity of views on the panel, and that was actually the way it was meant to be, since everyone's coming from a different perspective. If I had to sort of summarize it all and say, so is there going to be a disruptive force, and are we going to solve the financial inclusion challenge in 3 to 5 years, which was my original question? What I'm hearing from the panelists is that yes, it's possible, but there's still a lot to be done. The disruption is already happening, so it's not like it needs to start. We are already on that pathway. But there's some very key things that need to be worked on, whether it's on the customer service end, whether it's on how do you enable the human interface to be better service, to enable better service delivery, or how do you really leverage the technology, and the power of technology that we have in our hands today to address that. So I think those key pieces will need to fall in place for us to be able to say even more confidently that yes, in 3 to 5 years we would have solved the financial inclusion challenge, if not conclusively, but to a large extent. That's how I would summarize it. I have a few specific questions for each of the panelists, coming from their very unique perspectives. And I would request you to sort of limit your answers to maybe 2 minutes or so, because we do want to keep some time for question and answers as well. So Ragini, I'm going to start with you. You talked about DFID's focus in this area, the fact that the program you're running is focused on the 4 poorest states. You also talked about how financial services needs to be driven to that lowest segment. So I just wanted to understand what specifically are you doing to ensure that the poor are included, but that they also benefit from these services, because we know that they can not just benefit, but they can also get harmed from access to some of these services as well.
So our initiatives through our programs are at 3 different levels. One is at policy, other is we work with the institutions, and third aspect is when we work with the clients. So with institutions, our support is largely to increase their footprint into deeper geographies. So that starts with some low-cost funds for them to open branches where we know that they will take a longer time to become viable. So we come in there to sort of fill in that viability gap. Other part is, but all this we do in a very scientific manner. It is not just that okay, these are poor and we look at the map and decide okay, you go there. We use one of the biggest achievement of the microfinance sector when it came out of the crisis was setting up a credit bureau. So most MFIs have to now report to the credit bureau, and that credit bureau report, if we look at a larger level, when we analyze where all these clients are coming from, it becomes very apparent where are the pockets where you have more MFIs and where you don't have. So it's very easy to identify those geographies. So that we use that lens to ensure that institutions move there. So it's not about physical movement, but also the transformation within the institution. So they all need to go through a social performance audit. They all have to go through a loan portfolio audit. They all have to go through a client audit, client protection audit, so that they become eligible. And here the assessments are not meant, at one level they are meant to assess them, so that institutions who are really away from us, because we care about the reputational risk the sector faces. So we ensure that we pick up the institutions who are doing okay at a particular, but focus on the gaps. So there's a capacity building that goes into the technical assistance. For example, we did so there are things we start at a sector level, which is like credit bureau report. Then we look at what is the poverty footprint of the institutions already. Then we look at how each institution is doing in terms of poverty outreach. And then how we can help them now move to a deeper poverty outreach. So these are some of the things. So the responsibility is a very much ingrained thing. And not only that, even gender lens within their own institutions and product delivery. Because finally they're dealing with 95% of women, and how does their staff interact? But again, like I said in the previous section, the charity begins at home. How do they treat their own women staff to be able to do that? So there are various things that given Microfinance, I'll quickly go to, so we work at the institution level. On the client level, we have a very large financial literacy program. So it's about building the capability both on the demand side, so that they are able to choose between the providers, between the products, and also helping them understand their role within their family. So we don't do typical financial literacy, saving, we tick the box on saving, insurance, pension, but also on certain gender issues, that creates barriers for them to access certain services. So are women just being conduit to receive the loan and or going beyond on what can we do better to ensure that some of the barriers are taken off. So that's where I start.
So I'm going to jump to Pallavi and ask the questions just so we break the monotonous sequence. So Pallavi, you introduced yourself as, with MFIN of course playing dual roles, but definitely that of a SRO, self-regulatory organization. Could you talk a little bit about what's the progress that has been made over the last, just year and a half, in terms of really setting the stage to ensure that many of your members and the sector at large is following the responsible finance guidelines and ensuring that these customers are really being benefited and not really being harmed through access to these services?
So since SRO was set up, I must admit there have been a lot of questions to us time and again, how we have been performing in public domain as well as in private conversations. What are we doing actually? It's not obvious. We don't come to know so many things happening. What are you doing? First, I would like to underline that it is important to recognize when an institution exists, it works within a realm of legal framework and within some boundaries. So, like we have been given jurisdiction by the RBI to report to it, but as of now, RBI doesn't allow us to put it in public domain. We have not been allowed. While we have also gone and said it to them, that people want to know what we are doing. And even our members, have been asking us, what have you done to this so and so when this has happened? You haven't told us. So I would say, the SRO concept as such is something very new in India, which was not existing. Nobody, only a regulator would say with authority, yes, I have, penalized so and so, put a press release. But till that now, it's an evolving process. In the US, we have the FINRA, for instance, an age-old institution, a very strong SRO, though still it's subject to criticism, but it has evolved to a stage where it has got a statutory recognition. We haven't reached that stage where we've got a statutory recognition. The Malegaon committee report said that SRO would be good for the industry because typically the asset size of microfinance industry 0.1%. If you compare to the entire, the portfolio, the credit portfolio in the country. So RBI not having that bandwidth, n number of issues, large number of people, but asset size small. So many problems. So let SROs take care of because they know about the industry that much. Now, having said that, what do we do? Let me definitely make some things open what we do. So one is on, as an SRO, it's important that we have a code of conduct and RBI regulations over there. We are supposed to be responsible that people comply to that. And there is no disrespect for that. And you feel if nobody is watching us, we can do anything. So let me say we have an enforcement committee and there are cases which come to them and full set of almost like a judicial process follows over there. So in recent times, I may not be able to say which institutions, but yes, we have issued show cause notices, censure notices, warnings, and even penalties. We have come to that level today. But it took us almost 1.5 to 2 years to reach this level. And with some, some kind of brainstorming and understanding why when we should need that. Can't we, consult members, can't we, guide them, please don't do this. But I think this doesn't work, One is that you have to have a deterrence effect. So one that is in place, let me tell you, that is working and there are cases which are put to that and not to the board as such, typically a separate independent committee which looks at that and then also brought to the notice of the RBI from time to time. We have a periodical report to the RBI wherein we give them, when we meet quarterly meetings, we highlight each cases. So our, the ball in our court actually stops. Once we put them to their perspective, now it is for them how they handle it. Because we haven't been told what to do next. And also because, we don't have the relevant teeth also. So we're working towards that, we become more strong and SRO system evolves and then we are able to work towards that. So it's been a very, I would say, even a very painful process for us to reach at this level. But yes, our members have cooperated and that there has been a demand for it that we do it. The good news is, I would say, even our members have been saying, yes, you should have teeth, you should take action. So that's where we have reached. Second is, I would say, is on the incentivizing good behavior. So that's also, I think, as an SRO, we are different, we are not a typical regulator. So we have to, recognize members who have been complying well, we have to recognize them. So we recognize them typically through, we have a common forum, common platform, where we publish list of members, like typically I would say an example is on KYC, Aadhaar has been made mandatory for all MFIN members. 100%, in fact, from 1st July, 100% for all customers, you have to take Aadhaar. Non-negotiable, and a penalty is also being put for that. Credit Bureau, any non-compliance, it's non-negotiable that has been put. Names would be highlighted even within the members. And there's a strong penalty out there. Recent times development, that's where. But people who have been doing good, performing well on that compliance, we are putting that and publishing it with the members and sharing with them that these are the examples that you should follow. So that's on the incentivizing, we are working more towards that. And also when talking of surveillance, we have a third-party validation. In a typical self-regulation, we ask members first to assess yourself on compliance, where you stand on responsible finance. So they would rate themselves at some very high levels, 94, 95. But no, what we do is we back it with an independent third-party validation. So those reports come to us, then we present it to them, we share with them. So it's like a strengthening exercise, strengthening the industry. So typically non-compliance is done and sharing with them that these are the areas, you will not be penalized here, we are doing it for your benefit, and then they have to work upon that. So this is a slowly evolving process. And then of course a lot of development initiatives that we keep taking. That's typically one that on KYC that I shared with you. So KYC, I would say on Aadhaar, we are doing it almost on daily, weekly basis. Wherever we draw reports from the credit bureaus, bring it to the attention of the members. So these are the matching records you have not been able to match. So you have to you have to plug the gaps. We coordinate with the credit bureaus, we pay for those reports actually, and a lot of analytics comes to us. Second is on the risk concentration, which I was just highlighting. We publish with our members, these are the districts which are very highly penetrated. You have to, take a conscious decision to move out so that the risk in the industry is minimized. So for business decisions, I would say you can only guide them. Now it is for them to take that. Having known there are risks in the industry, you should. So that's where you can keep on telling them, but beyond that you cannot rule their business decisions. So that's what we do. And also on financial literacy, we had a credit bureau financial literacy project, so which we are still working on, having a universal financial literacy project. And then on staff trainings we are developing modules, because what we are seeing over the years is that the understanding of microfinance, typically in the microfinance, the front end staff, that has weakened, because the earlier staff, which was from the AP crisis, which we know of, those people keep on, a lot of attrition happens in the industry. They don't know how the industry has evolved. So we need to tell them how the chronology, the historical background, what are the sensitivities of this sector. So we need to develop that. And another is, we have a very now strong grievance redressal mechanism in place, which we earlier felt wouldn't work. Our members felt, this wouldn't work. We have a helpline. But to tell you, we have almost 1,200 calls per month being received on that number. We have developed that in-house, and we are slowly, expanding it to other model also. So that's something the development of nutrition.
Okay, thank you. Vipr, I'm going to jump to you and just ask you to summarize very quickly. You heard a lot of excitement around payments banks, small finance banks, a lot of expectations from FINO as one of the payment bank licensees. Where do you see yourself sort of fitting in this space of several players, and especially where are you seeing strategic partnerships or alignments with existing players?
So, FINO, Paytech, we were never a product innovation company. We were a service-driven company. And our whole approach was simplifying the processes for service delivery. So what internally we have a concept of an OTC kind of a product, which is, can you deliver this product over the counter? And financial institutions have big risk appetites and big balance sheets. We look at only those products with the financial institutions where we can modify it to a limit in which they can be delivered over the counter. So let me give you an example. In 2007, we launched with Union Bank of India a Tatkal remittance money transfer service, which was that the customers in your branch can be migrated, which have come specifically for transferring money outside the branch. And initially we started with our agent sitting inside the branch premises at a separate counter, and then that agent took up a shop just next to the branch, and the branch was sending the customers to, and the simple transaction which was crowding the branches was of transferring just money to, so we made that product over the counter. We took it outside the branch, and so all the products, like including savings, remittances, credit is one product we are focusing on, taking it over the counter. Micro insurance, Rashtriya Swasthya Bima Yojana, FINO was one of the members in drafting the whole guideline. So all these things, the approach of FINO has been that to complement an institution and making products simpler and decongesting the present banking infrastructure and taking it to the over-the-counter kind of a phenomena. And next things which is now coming in is how you can. So in around 2009 also we started the business correspondent model of JLG lending, which is now prevalent with banks, and we thought that JLG was a product inside the bank branches. It was there. It was never. The MFIs had it. The banks also had it. So how could we take that product outside from the bank branch and deliver it outside, linking with all the credit and everything in place as per the bank's requirement. So next thing in this is that we anyways will be not a competing player with. We will be complementing the big financial institutions in delivering the product. The philosophy, I said, we identify OTC and non-OTC products, and we'll keep on working on making the non-OTC products into an OTC kind of an environment. Next thing which is we are working is on the microcredit, 10,000 rupees, 8,000 rupees. When we started our MFI journey, around 5,000 rupees was the minimum ticket size. Now it has gone up to 40,000, I guess. I keep hearing 50,000 also. But the small ticket size product has to become an OTC product, and that is the path payment. FINO as a payment bank will take that. How do we take that product as OTC? The 30,000 or the 40,000 products I don't know. That is largely micro SME kind of a product. But then complementing the banks to deliver that small microcredit, and then work on MSME and this kind of a segment. But the approach being complement a financial institution to make a product over the counter and deliver.
Great, thanks everyone. Puneet, I'm going to jump over you and see if there are any questions from the audience, and hopefully you'll get a chance to respond. And we have run out of time, so we take about 2 questions.
Yes, quick question. So I just want to follow up on the first question you put about getting this ideal situation of financial inclusivity. So just adding another dimension to all the financial products we're working on. This ideal goal of financial inclusivity, it will deal with working with these traditionally unbanked population and first-time bankers. So what is the efforts being done by the industry to change make the cultural shift for people who believe that money in hand is worth money in a box? So how are we bringing them over to this side of the equation?
Okay. Before we answer that, we'll take one more question. Yes.
My question is, because the session was more primarily around inclusive investment, so we are hearing about farmer suicides happening in different parts of the country. The country is going to be in drought this year. This is what largely the predictions are. So, what role do MFEs see themselves in this coming period? And is there any scope of offering credit which is inclusive, which can be waived off? I mean, what is largely, I guess my question will be more to Pallavi, what is the private sector looking at this point of time to come from?
Okay, so for the first question, any of the panelists want to take a shot at that?
My view on that may be a bit contrarian, is that not much is really being done. It's a very, very important element. Consumer protection is actually going to become a fairly large issue. But today, we are seeing still just the accounts and the transactions are just starting to happen. People are not experiencing it much. Most of the business that's today happening is more like a remittance. So money moves from one end to another, gets taken out. The money is not really staying in the system. But once that starts happening, frauds and other kinds of risks for consumers and for channels, and we are seeing this in other countries which have been ahead of the curve on transactions. That's the point at which consumer protection becomes really important. And then basic financial education and financial literacy. So we really don't see much happening there, and that's really a need of the hour.
It needs to be done on a mission mode, like the Sarv Shiksha Abhiyan or something. That would be an idea.
Anyone wants to take the question on the farmers and credit availability for farmers?
Sure, when she has asked me, I'll definitely take that. But at the outset, let me mention that any case related to suicides, please not related to microfinance industry. The problem that you are addressing relates to agricultural credit, let me tell you. Because microfinance industry does not have a product for agricultural credit. They do not have. What they do is they have group loans for.
I know.
I'm just saying
So
that.
the idea of asking the question is this: are there any thoughts about coming into?
So yeah, not
in fact, Supreme Court itself has come up with that.
Yeah, absolutely. Yeah.
Look, 5,000 loan taker of farmer has to commit suicide and 5,000.
Yes, absolutely. I mean, you have the big corporates going away, fleecing the country, but yes, you have the farmers, small farmers committing suicides for small ticket size loans. So that's a problem which I would say has to be taken at a social aspect also, but also at the public policy aspect also. The agricultural credit in India is not designed as such. The way, the product, the agricultural, you have the monsoon, you have, the harvest season, it is not designed that way. And if there are vagaries of nature, how to restructure them, reschedule them, there has to be a system built for that. So that I think, and coupled with how to tackle, the drought and floods, these are something that have to be integrated. So these are larger policy issues which have to be addressed, I admit that.
Can I just make one comment? I guess you guys are in system of investment banking, which technically I really don't understand. But if you're talking about disruption and if you're wanting to reach that last person and you want those accounts to be operated, where are these people working? These people are working in the agricultural sector largely, right? So there has to be some innovation which can be done at your end, and some thoughts need to go into. I guess Ragini did try to address that.
I don't want to begin a different product for different situations. So what you're talking about the distress, it needs insurance. And there has been a lot of progress on the climate related and other insurance. It's about, and not to sound this, but the recent crop insurance scheme is really good. Even though you may not like the government, but that is a very good scheme. So again, it's about combining literacy, appropriate product, and a human interface in between. Like what are the incentives you build in the system for people to, like you go sell a health insurance, nobody will buy. What if I didn't fall sick for the year, I wasted 500 rupees.
You have to educate
so it's like that. So I think we are running out of time, so I won't go. But it's about different product for different situations.
All right, I just want to say thank you to the panelists for your views and perspectives, and I'm sorry we've sort of run out of time for questions, but we were told that there's time over lunch for you to interact more. So thanks everyone.
Thank you.